Hey there, fellow investors! Want to beat the street at their own game? You don't need a fancy degree or a Wall Street address. You just need a healthy dose of common sense. That's what Peter Lynch, the legendary manager of Fidelity's Magellan Fund, taught us. Lynch turned everyday investors into investing superstars. His secret weapon? Simple, easy-to-understand principles that anyone can use. We're talking about strategies that can help you spot the next Amazon or Tesla before they become household names. Lynch's philosophy is all about finding great companies in your own backyard. Think about the products and services you use every day. Those everyday experiences can provide valuable investment insights. This isn't about complex algorithms or insider trading. It's about opening your eyes to the opportunities around you. Remember, investing doesn't have to be complicated. With a little bit of knowledge and a lot of common sense, you can achieve your financial goals. Let's dive in and unlock the secrets to investing success. One of Lynch's most powerful principles is invest in what you know. This simple yet profound advice can be a game changer for both novice and seasoned investors. It's simple, but incredibly effective. By focusing on industries and products you're already familiar with, you can make more informed decisions. Think about it. What do you spend your money on? What are the brands and products that you use daily and can't live without? What products and services can't you live without? These are often the companies that are worth looking into for potential investments. Those are your starting points. Your everyday experiences can provide valuable insights into market trends and consumer behavior. Let's say you're a coffee fanatic. You can't start your day without your favorite latte. That's valuable information. You can't start your day without your favorite latte. That's valuable information. Start paying attention to the coffee shops you frequent. Start paying attention to the coffee shops you frequent. Notice which ones are always busy and which ones are expanding. Is there a local chain that's rapidly expanding? Are they opening new locations and attracting more customers? Are people going crazy for a particular brand of coffee beans? These are clues that could lead you to your next winning investment. These are clues that could lead you to your next winning investment. The coffee industry is just one example. Maybe you're a sneakerhead, always on the lookout for the latest and greatest kicks. You probably know more about the sneaker market than you realize. You probably know more about the sneaker market than you realize. Which brands are generating buzz? Which styles are flying off the shelves? Which brands are generating buzz? Which styles are flying off the shelves? This knowledge can give you an edge in identifying promising companies in the footwear industry. Which styles are flying off the shelves? This knowledge can give you an edge in identifying promising companies in the footwear industry. This knowledge can give you an edge in identifying promising companies in the footwear industry. Or perhaps you're a tech enthusiast who lives and breathes software. Or perhaps you're a tech enthusiast who lives and breathes software. You're constantly trying out new apps and gadgets. You're constantly trying out new apps and gadgets. That passion for technology can translate into investment opportunities. That passion for technology can translate into investment opportunities. Which software companies are developing the must-have apps of tomorrow? Which software companies are developing the must-have apps of tomorrow? Which ones are solving real-world problems with innovative solutions? Which ones are solving real-world problems with innovative solutions? By tapping into your existing knowledge and interests, you can gain valuable insights into potential investment opportunities. By tapping into your existing knowledge and interests, you can gain valuable insights into potential investment opportunities. Your personal experiences and passions can be a gold mine of information, guiding you towards smart and profitable investments. The financial world is full of noise, analysts making predictions, experts offering conflicting advice, and the market going up and down like a roller coaster. It's easy to get caught up in the frenzy. However, successful investors know how to tune out the noise and focus on what really matters, the fundamentals. A company's fundamentals are the key indicators of its financial health and potential for growth. These include things like earnings, revenue growth, debt levels, and cash flow. Instead of obsessing over short-term market fluctuations, focus on understanding the underlying business of the companies you're interested in. Are their sales and profits growing steadily? Do they have a solid track record of innovation? Are they well managed and financially sound? These are the questions that will help you separate the winners from the losers. Remember, investing is a marathon, not a sprint. Don't let the noise of the market distract you from your long-term goals. Stay focused on the fundamentals, and you'll be well on your way to building a profitable portfolio. Section 4. Spotting the winners, from stalwarts to fast growers. Peter Lynch, a legendary investor, categorized companies into 6 different types, each with its own set of characteristics and potential for growth. His insights have helped countless investors navigate the complex world of stock picking. Understanding these categories can help you identify investment opportunities that align with your risk tolerance and investment goals. By recognizing the traits of each type, you can make more informed decisions and build a diversified portfolio. Slow growers. These are typically large, established companies with steady but unspectacular growth. They are often in mature industries where rapid expansion is unlikely. They often pay dividends, making them attractive to income-oriented investors. These dividends can provide a reliable income stream, especially during volatile market conditions. Think of utility companies or consumer staples giants. These companies provide essential services or products that people need regardless of economic conditions. Stalwarts. These companies are larger and more established than slow growers, but they still have room to grow. They often have strong market positions and competitive advantages. They might not be the most exciting investments, but they can provide stability and consistent returns. Investors often turn to stalwarts during uncertain times for their resilience and reliability. Think of blue-chip companies with strong brand recognition. These brands have built trust and loyalty over the years, making them less susceptible to market fluctuations. Fast growers. As the name suggests, these companies are all about rapid growth. They are often in emerging industries or sectors experiencing significant innovation. They operate in industries with high potential and are constantly innovating and expanding. This constant drive for growth can lead to impressive returns for investors who get in early. They can be riskier than slower growing companies, but they also offer the potential for outsized returns. Investing in fast growers requires a higher risk tolerance and a keen eye for emerging trends. Think of tech startups or companies disrupting traditional industries. These companies are often at the forefront of technological advancements and can redefine entire markets. Cyclicals. These companies are sensitive to economic cycles. Their performance is closely tied to the overall health of the economy. They tend to do well when the economy is booming but struggle during downturns. Investors need to time their investments carefully to maximize returns from cyclicals. Think of automotive companies or airlines. These industries often see significant fluctuations in demand based on economic conditions. Turnarounds. These are companies that have faced challenges in the past but are now on the path to recovery. They may have undergone significant restructuring or changes in management. They can be risky, but if the turnaround is successful, they can offer significant upside potential. Investors need to be patient and willing to take on the risk of a potential failure. Think of companies undergoing restructuring or facing increased competition. These companies often have valuable assets or strong market positions that can be leveraged for a successful turnaround. Asset plays. These companies have valuable assets that are not fully reflected in their stock price. These assets can provide a hidden value that savvy investors can capitalize on. These assets could be anything from real estate to intellectual property. Identifying these hidden gems requires thorough research and a deep understanding of the company's balance sheet. Identifying asset plays requires careful analysis and a deep understanding of the company's balance sheet. Investors need to look beyond the surface to uncover the true value of these companies. By understanding these different categories, you can start to spot the winners in the stock market. Each category offers unique opportunities and challenges, and knowing where to look can give you a significant edge. Look for companies that fit into categories you understand and that align with your investment goals. With the right knowledge and strategy, you can build a portfolio that stands the test of time. Section 5. Patience pays off, a long-term investment approach. In the world of investing, patience is not just a virtue, it's a necessity. The stock market can be a volatile place, with prices swinging wildly based on news, rumors, and short-term events. However, those who can weather the storm and stay the course often find themselves rewarded in the long run. Peter Lynch was a firm believer in holding stocks for the long term, and for a good reason. He famously managed the Magellan Fund at Fidelity Investments, achieving an average annual return of 29.2% over 13 years. His success was largely due to his strategy of buying and holding stocks of companies he believed in. Short-term market fluctuations are often driven by speculation and emotion, while long-term market trends are driven by fundamentals. This means that while the market might react sharply to a piece of news today, over the years, the true value of a company will shine through. If you've done your research and believe in the companies you've invested in, don't panic when the market takes a dip. Market downturns are inevitable, but they are also temporary. Instead of selling in a panic, consider it an opportunity to buy more shares at a lower price. In fact, market downturns can present excellent buying opportunities. When prices are low, you can purchase more shares for the same amount of money, setting yourself up for greater gains when the market recovers. Remember, time is your ally when it comes to investing. The longer you hold your investments, the more time you have to benefit from compounding returns. This is the process where your investment earns returns, and those returns then earn returns themselves. The longer you hold your investments, the more time you have to benefit from compounding returns. Over time, this can lead to exponential growth in your portfolio, turning a modest initial investment into a substantial sum. Compounding is the snowball effect of earning returns on your initial investment plus any accumulated interest or dividends. It's a powerful force that can significantly boost your wealth over time. It's like magic, but instead of pulling a rabbit out of a hat, you're growing your wealth exponentially over time. The key is to start early and be consistent with your investments. So the next time you're tempted to chase a hot stock tip or panic sell when the market dips, remember the power of patience. Ignore the noise and focus on the long-term potential of your investments. Stay focused on your long-term goals and let the magic of compounding work its wonders. By maintaining a disciplined approach and keeping your emotions in check, you can achieve financial success and build lasting wealth.